Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the Chapter 7 short exercises that were assigned in the digital study guide. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we are now working on problem 711, and it says here, Umbrella.com had the following balances on December 31st before the year-end adjustments. So this is pre-adjusted, okay? Accounts receivable of 105.6 and allowance for uncollectible of 2,000. The aging of receivables yields these data. Right? So when they age the receivables, these are the dollar amounts by period of how old those accounts receivable are, and these are the percentages that they apply to that to those amounts. Right? So it says here, journalize Umbrella's entry to adjust the allowance account to the correct balance on December 31st. All right, so we're going to take our 1 to 30 days is 66,000 at 1%. So 66,000 times 1% is 660. $660. So I am going to just kind of like list these over here. Right, do the math all up in here. Then for the 31 to 60 days, I have 24,000 at 2%. So 24,000 times 2% is $480. '61 to 90 days, 12,000 at 6% is $720. And the over 90 is 3,600 at 53%. Which is $1,908. So when we add those all up, I get 8, 10, 16, 10, 27, to 37, 68. Okay, so what we've done is we've said, okay, based upon this aging of our accounts receivable, we feel that our allowance for uncollectible accounts should have a balance of $3,768 in it. Okay, but right now the balance is $2,000, so we have to make an adjusting entry for the difference between those two numbers, right? And that would be $1,768. That is the amount that's going to be in the for the adjusting entry, right? So let me just kind of like quickly show this here. Remember, this is our T account right here, right, for our allowance. And it already has a balance of $2,000 in it, all right? Well, we did the new calculation. We said, based upon this aging, we should have a balance of $3,768 in our allowance for uncollectible account. Well, we have to make an adjusting entry to get it to that amount. We're going to back into that amount. Well, how much are we going to make that entry for? So we subtract one from the other, and we determine we have to make the entry for $1,768. Okay, so when we determine that $1,768, then we make our adjusting entry to debit our bad debt expense for the 1,768, and we're going to credit the allowance, and I'm not going to write the rest of this out, the allowance for uncollectible accounts for 1,768. So this is my journal entry, my adjusting journal entry, and at the end of the accounting period when I age my accounts receivable. And that's all there is to it. But notice, and if you watched the theory videos or you watched the last video for problem short exercise 7-10, that was also showing how we're constantly backing into the amount that we need for our to figure out what our actual, we're going to calculate an estimate, and we can't just do that calculation and say that's what's going to bad debt. No, we have to back into whatever figure it is that we need to make the adjustment for in order to arrive at the balance that we need. And that was covered in short exercise 7-10 also. So if you need more, look at it again, go ahead and watch that video. All right, so that's that problem. All right, 7-12. Let's see here. It says internal controls. Claire Billett, the office manager of a local office supply company, is designing its internal control system. Billett proposes the following procedures for credit checks on new customers: sales on accounts, cash collections, and write-offs of uncollectible receivables. For each of the 4 procedures, indicate whether the procedures includes an internal control weakness, explain how employee fraud could occur because of the weakness, and what can Claire do to strengthen the internal control system. All right, so let's see here. It says A, the credit department runs a credit check on all customers who apply for credit. Well, that's good. When an account proves uncollectible, the credit department authorizes the write-offs of the accounts receivable. Okay, that's good. B, cash receipts come into the credit department, which separates the cash received from the customer remittance slips. The credit department lists all cash receipts by customer name and the amount of the cash received. That seems a little weak to me. C, the cash goes to the treasurer for deposit into the bank. The remittance slips go to the accounting department for recording of the collections. And that seems all right to me. And the controller prepares the daily deposit slip to the total amount of the collections recorded. Both amounts must agree. Right? That seems somewhat fine to me. All right, so let me look at the answer here. It says procedure B is the only procedure that includes an internal control weakness. The internal control weakness is the lack of separation of duties, which I agree. Separation of duties. That allows the credit department to receive incoming cash receipts from customers and the authority to write off the accounts receivable. So here it's saying that the credit department can write off the accounts receivable, but here they're also controlling the cash. So, who's to say, remember the credit department is doing both of those functions, right? They're writing off and they're, let's see, ship the cash. And they're the ones who separate the cash from the receipts, right? So who's to say that that person in the credit department when they receive the cash, right, and that receipt, that they take the cash and put it in their pocket. And then because they have the ability to write off, they go ahead and write off that account, and that accounts receivable is no longer on the books. And so you never see that cash. Okay? You never see that cash coming in because they've pocketed the money. So you need a separation of duties. Somebody else should be handling that. So the answer says, with access to cash, credit department employee can pocket cash received from a customer and destroy the related remittance slip. The employee can then authorize the write-off of the customer's account as uncollectible, and the company will stop pursuing collection from the customer. And it's as if they've never ever seen that accounts receivable. To strengthen the controls, the company can have customer checks go to a lockbox controlled by a bank or to the company mailroom, not the credit department. Okay? Or, even within the credit department, you can have, you can have two different people, which is by having the lockbox or by going to a bank or something like this, or the mailroom. Basically, what you're doing is you're separating those duties. You're having one person do one thing, they're the ones that are handling the cash, and you have the other person who's doing the write-offs. Okay, so in the credit department, you can have the two different people in that credit department doing the two different functions. All right. The whole point being is that here for B, the credit, and we're kind of like, if you only had one person that handled the credit department, then obviously you should have a lockbox or a separate, the mailroom handling it, somebody else handling it, period, because there's only one employee in the credit department. And to be honest with you, if you only had two employees, I would be a little bit leery of that also, because they can easily collude. They're sitting together all day. They could cook up a scheme and just start ripping you off. All right. But if you had a bunch of people in the credit department, well then yeah, you would have this lockbox, or you can have the whatever come, and the manager would designate some person, right, in order to be able to handle those cash receipts, and person two would be the one who would handle the write-offs. Okay, but then again, you're talking about having a lot of employees, and honestly, I would if it were me and I had like 10 employees, I would actually be mixing those duties up, meaning I'd have people cross-trained, and I'd probably have them designated to be handling that work on specific days in the week, so that no one person is performing that same function all the time. Right, so that was a theory, exercise in order to understand a little bit about internal controls. And if you have any questions, this is not going to be, probably is not, no, it isn't covered that much in the theory video. So if you don't understand something here, feel free to contact an instructor. And I'll see you in the next video for the next exercise.